for this mock exercise, we're going to take a look at a case called McDonald Corporation, and it's a merchandising operation, and we're going to calculate some missing amounts and look at profitability. So let's take a look at this question. So in this question, you're given the following information: an income statement, a balance sheet, and some additional information regarding a company called McDonald's Corporation for the years ended 2011 to 2013. You're asked to calculate the missing information from item 1 to item 10. And they use the perpetual inventory system, and they all purchased inventory on account. So the first part is asking us to calculate the missing information. The second part asks us to calculate the gross profit and net profit margin based on the following 3-year period. And for part 3, it's asking us that if sales have increased from 2011 to 2012, does this also mean that profitability should also increase in the same period? So let's take a look at how do we solve this problem. So solving this problem allows us to understand the relationship between certain concepts. So for example, we know that gross profit is the difference between sales minus cost of goods sold. So we can probably quickly figure out number 1, because we've got cost of goods sold and we have gross profit. So let me put that here. So number 1 is we have net sales equals cost of goods sold plus gross profit. I'll just short form it. Cost of goods sold is 81,300 plus 144 to give us sales of 225,700. So let me write that down here. So this one is 225,700. Now, what's next? We know the relationship between gross profit and net profit or net income is we take gross profit less operating expense to get us net income. So we could probably solve number 2. So number 2 is operating expenses equals gross profit minus net profit or net earnings. So gross profit we know is 81,300 and net profit is 36,000. So operating expenses is 45,000. So that one's not so hard. So let me write this down. Now, let's see if we can solve number 3. Number 3 says this is our ending inventory, and we're told that inventory are all purchases of inventory on account. So the best way to solve number 3 is to use the equation beginning inventory plus purchases minus ending inventory gives you cost of goods sold. So we do know that the beginning inventory is last year's ending inventory. So that was 14,700. We do know the purchases. Purchases on account was 141 minus ending inventory. We do know the cost of goods sold that was given to us at 144. 400. So solve for ending inventory. Ending inventory is 11,300. So we know that this is 11,300. Okay, so now we're going to look at cash paid to supplier. So under cash paid to supplier, it's probably not a bad idea to do a T account here under accounts payable. So I'm going to use the accounts payable T account for number 4. And what do we know? We do know that the accounts payable ending balance is 125. That's the, so that's 25,000 is the ending balance. Okay? Now we don't know the beginning balance. So this is number 7. Okay? Now, we do know the purchases. We made $141,000 of purchases, right? So that would be a debit to purchase and credit to, or debit to inventory, credit to accounts payable. Okay? So these are purchases. So this is what we're looking for. So cash paid to supplier, right? So we don't have, because we have 2 unknown information. So we might need to solve number 7 first. So number 7 is asking us for the ending accounts payable, but we do have the beginning, don't we? So maybe we need to do this one too as well. So this one is 2012, and this is 2013. So we might want to do another accounts payable T account, and this time we want 2011. So the beginning is 20. That was given to us. So the beginning balance is 20. The ending is unknown. This is number 7, right? This is the unknown for number 7. Now we do have some information. Do we have cash payment to supplier in 2012? Yes, we do. We have 161. So we know that this is 161 here. So cash paid in 2012. This is 2013. Okay? So this is the power of the T account. Right? So we do have that. Do we have the purchases, number 8? We don't have the purchase, right? So this is number 8. So far we've got number 8, number 7, so we need to solve number 8. By solving number 8, we can get number 7. By solving number 7, we can get number cash paid to supplier, number 4. So we need to solve number 8. So number 8 is purchases. Now, how did we determine purchases? Do we have the beginning and ending inventory? So we've got the beginning and ending inventory. We do have the cost of goods sold. Okay, we can figure out number 5 quickly, can't we? So let's do that first. So for number 5, we can figure out the cost of goods sold for 2012. So cost of goods sold 2012 is, we know, net sales less gross profit. So net sales is 227,600 plus, actually it would be net sales minus gross profit, would be 80,100 to give us cost of goods sold of 147,500. So if you notice, what I've done here is I tried to solve the unknowns based on the way the question is given to me. But clearly, for number 4, I needed to solve the cash paid to supplier. But when I plug in what I do know, I need the beginning accounts payable balance. So it forced me to do another accounts payable that basically allows me to find the ending 2012 to give me the beginning for the 2013 accounts payable T account. Now, you'll see that when I do this, I don't have the purchases, but I can find the purchases because now I know what the 2012 is. So let's go and find number 8. So again, for number 8, we need the 2012 purchases. That's what we're looking for, right? So let's go back to that basic equation. Beginning inventory plus purchases minus ending inventory gives you cost of goods sold. Do we know the 2012 cost of goods sold? Yes. We found that out from calculating number 5. Okay, so this is 2012. Do we have the 2011 inventory? Yes, we do. We have 10,000 of ending inventory, right? Beginning inventory. Now, we don't have purchases, but do we have the ending inventory? The answer is yes. We have 14,700. So now we're going to take a look at and solve for P. That's 2012. That gives us 152,500. So this is actually number 8. So this is 152,500. So we got number 8. So now let me come back to this. So we know that the 2,000 purchases is 152,500 here. So let me show you with a different ink here. So now, can I solve for number 7? So we've got the beginning of 20 plus the 152 minus the 161. This gives me 11,200. That solves number 7. So number 7 is 11,200. Now, we know that 11,200 has to be the beginning and that will be the beginning for the 2013 accounts payable T account. So now we can solve number 4 because now we've got 11,200 plus the 141 purchases minus X to give you the 25. So this is 32,600. So that is 32,600 for number 4. So we're able to get the 1, 2, 3, 4, 7, and 8. We got number 5, didn't we? We just calculated number 5 to be 147,500. So we're able to get that. Now we can do number 6 too, right? Okay. So number 6 is just net income is gross profit minus operating expenses. Gross profit is 80,100 minus operating expenses to give us 33,100. So this is number 6. The hardest part in this question really is this accounts payable relationship between 2012 and 2013. And I wanted to show you the T account because it's important for us to visualize that all purchases are credit and all payment to suppliers are debits. And you can see that I needed to do the 2012 accounts payable and then 2013. Now, when we do that, and let's put down what we do know, the information we do know, we do have some missing information. In this case, we needed the purchases to be able to calculate the ending accounts payable to allow us to solve for the cash paid to supplier for 2013. So to solve that, we needed to figure out the cost of goods sold and number 8. So you could see that there's a couple of steps, but having to visually look at the relationship of the missing information allows us to take a step back and understand what information we needed to solve before we can solve the unknowns, the critical unknowns. Now, we still got 2 more information that's missing, 9 and 10, but that's easy because we know 9 is gross profit, which is sales minus cost of goods sold, and we can solve 10 the same way we solve for number 1. So let's do that one next. Okay? So in solving number 9, that's easy. Number 9 is gross profit is sales less cost of goods sold. Sales is 219 less 133,500 to give you 86,000. So that is number 9. And of course, number 10 would be 86,000 minus 30 to give you 56,000. So for number 10, operating expenses equals gross profit from number 9, okay, which is 86,000, minus net profit, which is 30,000. Okay, so this is a great way to test whether you understand the relationship between cost of goods sold and inventory purchase on account and cash paid to suppliers. So having that, understanding that relationship of how an income statement expense item relates to the balance sheet item, and the balance sheet item called accounts payable, how that relates to cash paid to supplier and purchases, are important concepts here. And now, and this is a great way for us to also test it in a multiple choice question. So having a really clear understanding on how you find this missing information is an important learning objective. Now let's look at part 2. It says calculate the gross profit net profit for the period. So that one there is not so hard. So gross profit, so we're talking about 2013, 2012, and 2011. So gross margin is gross profit divided by net sales. So this one is 81,300 divided by 225,700. This gives us 36%. And this is 80,100 divided by 227,600. Gives us 35.2%. And this is 86,000 divided by 219,500. Okay, now the profit margin, so this is gross profit margin. The profit margin is net income over sales, right? It's called net profit margin. And that is 36,300 divided by sales, net sales normally. Okay, now part 3 says if net sales went up by 2 in 2011 to 2012, so we know that that was the case. So net sales went from 219 to 227. okay? And it says, does it mean that profitability should gone up? The profitability went from 30,000 to 33,100. But look at the gross profit. It went down, didn't it? Gross profit went down from 39% to 35%. So that means that if gross profit went down, it means that the cost of goods sold must have increased as a percentage of expenses. So if you look at cost of goods sold, the cost of goods sold went up, and it outpaced the increase in cost of goods sold was much higher than the increase in sales, resulting in a lower gross profit percentage. And that implies that perhaps the company McDonald's had a lower or weaker purchasing power or control over the cost of the goods purchased. So in spite of increase in sales, the profitability actually went down, deteriorated, because they couldn't buy the goods at a cheaper cost. Now, the good news is the gross profit, net profit percentage went up. That means that they were able to control operating costs much more than in 2012, and you can see that from looking at the difference, right? The operating expenses went down. So despite the decrease in gross profit margin, we're able to control our operating expenses, resulting in an increase in net profit margin. Thank you.